Welcome back. Now we're going to talk about the balance sheet of the business. So the balance sheet is essentially a statement that breaks out all of the company's assets, liabilities, and then a thing called owner's equity, which just reflects the net income the company's generated over the years that it's been in business, combined with contributions or withdrawals the owner or shareholders have made into the business. So this formula here in red at the top is the key. The total amount of assets will always equal the liabilities plus the equity. And you'll see that as we walk through a business. But just to give you an example, when a business is started, for example, the owner may contribute $5,000, let's say. It's on day one. And what does that mean? That means the business will now have cash of $5,000, right? Owner put in 5,000, so now the assets of the business are $5,000 of cash. You'll see assets equals combination of liabilities and equity. Now we're going to just go through what a common company's balance sheet may look like at a particular point in time. So what are the common assets? So first off, we've got cash, like the example we just gave. So I'm just going to put in some examples here. Let's just say the company has $14,600 of cash that's just sitting in the bank. Then there's a thing called accounts receivable. And what accounts receivable is going to be is essentially when, let's say this t-shirt business, we've sold 50 t-shirts to a distributor at, at whatever value. In this case, let's say the total value of $1,500, but that distributor hasn't paid us for that yet, right? So we sold the t-shirts, they have an invoice, they just haven't paid it yet, so we're expected to receive $1,500. So this is an item that the cash is going to come in the door. We've already earned it, but we don't actually have the cash yet. Okay. Then there's an item called inventory. This is essentially a number reflecting the inventory of in the business. So for example, it might be extra ink or it might be blank t-shirts. What the value of those t-shirts are. So let's just say we ordered $3,000 worth of blank t-shirts that we haven't actually used to make t-shirts that we're going to sell yet. So they're sitting in inventory. At a certain point in time, we will recognize the cost of that when we're in our income statement, but we're going to, at this point, it's just in our inventory because we haven't actually made the t-shirt yet that we're going to sell. So that's inventory. And then there's an item called prepaid expenses. And essentially, prepaid expenses are what it sounds like. It's an expense that we're prepaying. So, for example, maybe the company has insurance and we prepaid for the entire year at the start of the year. So in this situation, we'll just say $200. But for example, that $200 is going to represent insurance over the course of the whole year. So it's really going to be like $50 every quarter. But for right now, we're recognizing this $200 that we've prepaid, and it's an asset to us though because it's a service that we're getting over the course of the next year that we have not yet reflected on our income statement. So those are the common short-term assets, and we can say we'll show them here as total short-term assets. I'm just going to throw equals all four of them together, and I have $19,300 of short-term assets. Now I'm making a little more space here because there's another thing called long-term assets. So an example of a long-term asset might be an equipment or computer. So for example, let's just say we have a heat press machine that we bought for $6,000. Okay, that $6,000 has value. Now that heat press machine might be lasting us, we expect it'll last us for 10 years. So while it costs us $6,000 up front, we don't want to think about it as a $6 expense just in this year because it's going to last us for 10 years. So a common thing would be straight line depreciation, it's called, which essentially means we're going to recognize $600 of that expense every year, right? 6,000 divided by 10, 600. So every year we're going to say our expenses for our equipment are going to be $600. So we'll see that in the income statement, but for now, how do we reflect that in the balance sheet? Well, $6,000 is the equipment we got up front. After a year, we're going to have an item that's going to say the depreciation on that equipment. So over the first year, we're going to recognize that as $600, right? The following year, it'll be an additional $600. So the way to show that, what it will look like after 1 year, for example, is we bought it for $6,000. There's $600 depreciation on it after a year. So the net of that is just going to be these two things of $5,400. So after a year, our depreciated equipment value is $5,400. So as you can see, obviously, after 10 years, this will keep declining by $600 a year. After the 10 years, the value on our balance sheet will be zero. Now, it's possible we continue to use this machine beyond that, but for now, we're just recognizing it's what we're expecting to expense every year. And this way you can see what the current depreciated value of the equipment is. So those are kind of the main assets. Every company might have other different things that are relevant to their business that might make it slightly different. But in this case, we're just going to stop here. Total short-term assets plus our long-term assets. In this case, it's just the equipment. And we have $24,700 as our total assets. Now, let's go down to liabilities. So what are some common liabilities? Well, accounts payable is an obvious one. This is just like accounts receivable, only it's the flip side. So this is a situation where we ordered something, maybe we ordered those blank t-shirts or some extra ink, but we haven't actually paid the bill for them yet, right? So let's just put, and it could be an aggregate of a bunch of these different things. So let's just assume we have $2,200 here. So again, we ordered blank t-shirts, we got the blank t-shirts, we have the invoice that we owe them $2,200, we haven't actually paid them yet, right? So this business has a liability of $2,200. There could be another item called accrued expenses, okay? Now this is basically something that is saying we already have the expense of something, we haven't actually paid the bill. So again, this might be the utility bill, let's say. So we've spent, let's just say $30 is the energy bill that we've had this month for our electricity, and we haven't paid that bill yet. That's $30 of liability that we have for that purchase. Our credit card bill could be another thing. There's random things that we've purchased on our credit card over the course of things, the business credit card, right? And there's a balance that we haven't paid yet. So let's just say that's $400. And then we're going to say loans. Maybe we took a loan from the bank, right? So there's a bank loan that we have. Let's just say that's $3,500. All right. And we'll total those up and they'll say those are our total liabilities. So the business. All right. So now we look back at the business. We have the business has $24,000 worth of value, but it also owes total of $6,130 for random different liabilities that we talked about. Now, the owner's equity is the last piece. And as you remember in the example earlier, this is going to be the capital contributed from investors. And in this case, there's the $5,000 that the owner originally contributed into the business. And then there's going to be an item retained earnings. Retained earnings is going to reflect the net income of all the past cumulative years that the business has been operating. In this case, let's say it's 13,370, right? And that's going to add up to our total equity. And we're going to have those two. And what you're going to see here is our total assets of 24,700. And what's our liabilities plus equity? Well, it's going to be this plus this. And you're going to see, oh, I made a mistake because my examples were slightly off, but 13,390. Sorry about that. 13,570. Okay. What's going to happen is that the liabilities plus equity of 24,700 will always equal the total assets unless you've made a mistake. And that essentially has to do with how we put together the net income and manage the balance sheet over time, and we'll work on this later, but you'll see that for every item the assets and liabilities go up or down, it's going to affect the net income, which will affect this retained earnings line. That'll make these things always equal. That's basically what essentially a balance sheet looks like, and we're going to get into the next step in the financial statement next. Thanks a lot.